Welcome to the Dividend Talk podcast, 2023 earnings season. Whether you're a seasoned pro or just getting started, Dividend Talk is the place to be for insights, analysis, and unsalted advice on how to make the most of your money through dividends with our own unique European flavour. I'm your co-host, Engineer My Freedom, and today I am joined by European DGI. So sit back, relax, and join us as we dive into the world of dividend investing and discover the power of passive income. Hey, European DJ, how are you, buddy?
I am really excited because earnings season has started. Finally, we can get all these dividend hikes from the European companies thrown in our face. And it has been already a great start, I would say, but more about that later. So I feel really excited. Earnings season, specifically this time of the year, is really exciting for me.
Yeah, I feel a little bit bad because usually we record on a Fridays, which means we get the full week, usually. But me and my travels, I'm traveling out and going away again this weekend. I'm going to kind of a remote part of Ireland, so there's no signal, so I'll be off the grid for about 3 days, which is good. But the downside is we have to record a day earlier, so we're missing some earnings. But hey, we got some great companies that we can capture that reported their earnings on Tuesday and today. So let's roll them out.
That's funny that you say it because now I've been in Ireland, and the fact that you say remote is really interesting because for me, where we were was already end of the world. So how much more remote can you go? You mean like off the grid?
I mean, the phone will not work. So like nothing will work at all. So you will not be able to contact me even if you tried. That's how remote. And it's like a little cottage in the middle of the mountains, and there's only mountains and lakes beside you. There's not a whole lot. So we'll just spend the whole weekend walking, maybe get into the water and so on. But it'll be a nice little break.
Well, take some of those fireworks with you. That when there's SOS, you can shoot them up in the air so that people know there's an emergency going on.
Yeah, they still won't be able to find me, but I'll bring them along anyway. Try to get through this. We have a couple of really good companies, and I think it's no surprise that we start with our darling Microsoft, ticker symbol MSFT. For me, I'm going to read out the headlines first. So to get the headlines, so they have revenue up 2% to 52 billion over the last 12 months, operating income up 8% to 20 billion, and net income was down 12% to 16.4 billion, which obviously reduces the earnings per share. Reading through the report a little bit, it's like a football game. It was like a game of two halves. Okay, so you had the weak side and then you had the strong side. The weak side first is obviously in their personal computing. That took a massive hit, and it was expected. I don't know if it was expected to be as big as it was, but it was certainly expected to have some sort of slowdown, particularly coming out of COVID and the slowdown in buying computer. People having a lot of cash hanging about, and they're certainly not buying Surface Pros or anything like that coming off the back of that. So that was a little bit expected. The good side then was their cloud growth. I mean, their cloud growth was exceptional across all areas of the business. We look at cloud revenue was up 22%. Azure revenue was up 31%. I mean, they're just really big numbers, aren't they? Particularly in a year where technically they've struggled. If you get me, like I tried to make a rule this year not to look at the share price before I read the earnings. So I stayed away from looking at anything over the last 2 days, and even from Twitter for that reason, because I know a lot of people will look at the share price and might base it on the share price. Maybe it was good or maybe it was bad. But honestly, I know they had a weak consumer segment, but everything else just looks absolutely perfect in my eyes, particularly the cloud growth. Going through their income statement, look, the cost of revenue went up understandable. Cost of materials, which they said, which drove the net income down. There was some general and administrative expenses, and research and development went up, but nothing in there that was to worry me. Inventories is the only thing that has gone up significantly. I think it's gone up nearly threefold. So it was 394 million. It's now just over 1.3 billion. Again, I think that's a trend we're starting to see across nearly all sectors like this. I wouldn't say it's worrying, but it's obviously going to have some sort of impact on their cash flow. But for me, they're starting to come. I'm expecting this kind of a cycle over the next 2-3 quarters where we're going to have weak consumer. I think even the business end is going to struggle a little bit. I think we're seeing lots of layoffs now, and businesses are going to start tightening their strings. Not so much in this quarter, but definitely in the next 2 quarters. I think that will drop along with the personal computing. Cloud growth will probably hold it steady. But I think as a result, we might start to see the share price come down, up and down over the next 2 or 3 quarters, but they're starting to come down to a very, very attractive price. I think the forward PE ratio is 24. If that gets down around the 20 mark, I'm back buying again.
Yeah, same here. And you know what I love about us just reading these quarterly reports, because they have the annual cycle always ending in the summer, is that we know already that Intel's earnings in 1.5 hours from now, actually, because it's Thursday today, will be bad. Yeah, that's my expectation on this one.
Yes.
But on the other, I need to give credit to Pat Gelsinger as well, because if I'm not mistaken, it was he who said in like 1 or 2 quarterly reports ago, like, look, the corporate hiring was one of the boons for the personal computers to grow so much also, right, during COVID. How many people were being hired in these big tech companies? So, and so there's a lot of corporate spending on that. And if they are firing people by the bushes now, a lot of equipment will be left. And what happens in those companies, they will not acquire new equipment for things that are getting end of life cycle. They will just reuse those ones that were used by former employees. So they are kind of building up an inventory. So I think we will see this a little bit longer, actually, if mass layoffs are happening everywhere in the corporate. So it will be really like, oh, my ass will be sweating with the Intel numbers. But hey, I'm in it for the long game. No, look, what I love about Microsoft as well, right? Still now, they have on the trailing 12-month numbers, they have 59 billion free cash flow, 19 billion in dividends, 28.5 billion in share repurchases. So that means that about still, now what is it? Let's say 18, 19 billion is left. Yeah. What have they done in the last 12 months? They have reduced long-term debt by 14 billion. So this, I mean, even with these repurchases that they are doing and everything, they are still massively generating cash, and their balance sheet continues just to strengthen and to grow. Equity to shareholders, just to mention, it was 183 billion right now. Back in 2017, it was 72 billion. Yeah, so 2.5 times more value to shareholders in equity. Yeah. That's compounding at a rapid pace, and the share count is slowly decreasing. So for me, I mean, I love the company, and on a dip I might nibble a little bit in to just expand my position, because like to what you say, a PE of 24, 25 is, in my opinion, the ultimate example of a Warren Buffett quote: buy high quality companies at a fair price. And if you mix this in with another purchase I did today with a stock that we will talk later about, also my average yield on acquisition is relatively nice. Yeah, then you buy a bit of high yield, compare it with a compounder like Microsoft, and my portfolio will generally do well and meet the targets.
Yeah, my only thoughts when I was reading through the press release and the slides was they talk a lot about cloud, and their focus is really cloud and AI. They're really pushing that route. So could you possibly see some sort of spin-off in the future where they spin off the kind of slow-going cyclical nature of the personal computer business and then really try and drive growth in the cloud AI?
Well, I think this happens because they created a flywheel. Yeah, don't forget that personal computer, if they have that, the hardware part allows them to understand really the impact of the software part. That's also why Apple likes hardware and software. And they also have Office 365 and all this stuff, which really needs to integrate well, also of course, and performance-wise. So I do believe it's not smart to do it. It's all part of the flywheel. But I could see if they come to a phase where the growth is ending and it becomes more about shareholder value at that moment in time and capital return, then I can see spin-offs happening, because this is now really a holding company, LinkedIn, but it's so deeply integrated with each other, right? And the flywheel is really now at the moment around the clouds.
Yeah.
But you need this whole ecosystem to drive it. Also, the investment in OpenAI. They have now an exclusive agreement to only leverage Azure. What happens with that? They get to learn everything about how to tune Azure towards those AI models. At the same time, it forces potential customers to use Azure. So for me, it's a brilliant strategy. And I don't see that in the next decade yet they need to spin these kind of things out, because it's all compounding on each other, all building on each other.
A flywheel is a good analogy. And you know what? I realized I didn't even mention LinkedIn. I mean, that grew 10% as well. I find that great.
And I mean, if you know what they paid for it and you see the annual cash flow coming out of it, it's already crazy. It earned itself already back. And then, of course, they will get Activision Blizzard into this ecosystem with a little bit of luck if it gets approved.
Potentially,
and
yes,
60 billion. I mean, on their balance sheet, it's an afterthought. Yeah, and even a 10 billion OpenAI, they do it just out of pocket this year. It's like literally like keep the change.
Keep the change.
Yeah. On one of the hottest assets of the last weeks.
Look, they are cash rich, and as I said, they're definitely coming in to my fair value range, and I'm getting close to loading up the truck.
And the irony of this all, Bill Gates, to my understanding, just acquired 9 billion in Microsoft shares as part of their philanthropy. What is it? With the Bill and Melinda Gates Foundation. He bought 9 billion in shares in a company that he founded.
That's wow.
Exactly.
Wow. I did not know that.
Yeah. If my understanding is correct, that's what happened the other day, because you have these, I don't know if it's a 13F, but they need to mention that, right? And they have an investment portfolio because that needs to pay for the foundation.
We talk about the psychology of averaging down. So when you buy averaging up on a company, okay? So you're buying a company and the price goes up and you struggle to buy it. Imagine being a founder of a company and then having to buy 9 million shares. That's psychology. That is psychology.
Yeah, that means also that you have character.
Exactly, and
believe in your successors like Satya.
Yeah. Okay, let's move on. We could talk about Microsoft all night. We'll move on to. I'll let you go with the next company.
Well, I think we have to just talk about ASML. Yeah, it's a darling, I think, in the European dividend community. I realize for Americans, it's a little bit like this awkward company that some people talk about somewhere there in the Netherlands. But ASML, also ticker symbol ASML, listed on the Dutch stock exchange. I mean, we spoke about this a few times already. They have a monopoly with all the equipment machines they create for the chip industry. Yeah, so TSMC, Intel, they pay billions of euros towards ASML to get their latest technologies. Even Intel and ASML have an agreement where Intel did like a large pay up of several billions to be able to get the first Nano 3.5 or was it machine. And I mean, they had amazing numbers again. So they got a bit beaten down earlier in the year because of the fact that they had some. What they did is they needed to ship faster, to their customers. So with that, they have later revenue recognition. So what it means, I believe they install the devices now, the machines at the customer site. And when we say a machine, guys, it's not like a machine like, I don't know, like installing a kitchen. No, these are highly specialized machines, as large as probably 2-3 bedrooms together at times. They need to stand on a special surface that is shock resistant, because one little microshock can already disrupt the whole production of this. So these are heavy specialized buildings. And so they had to install them there. And with that, also later revenue recognition. This year, they sold 40 of those expensive EUV machines, but they shipped 54. So those 14 will probably be accounted for this year. It's important to know that, to realize that. But still, then the margins are pretty decent again. They had a net sales in 2022 of 21.2 billion at a 50% gross margin and a sales growth of 14%. 14% is relatively low, let's say, for ASML, but this was already known since half a year ago with the half year results. So if we go to the outlook, for instance, they expect, I believe, a 25% sales growth, net sales growth in the upcoming year. What I really loved about the numbers, actually, is if you look at the memory business, it has been growing really a lot, from 4 billion to 5.5 billion, so 1.5 billion extra. The logic business was kind of flat.
Yeah.
But here's where the cash cow comes in. Because do you remember what they always said with Apple and the App Store? Yeah, that where Apple started to build really lots of recurring revenue with this, with the services that they are creating. ASML has a similar model. They went from 2.6 billion in 2018 to 5.8 billion almost right now in install base management. Yeah, and what I like about is that it feels like the share of revenue is increasing there. And I also know that sometimes they resell old equipment and such to other manufacturers again. So they're really smart with this, and there's a lot of money to be made there. And I really think they are nailing it on every side. Yeah, and then so I'm really excited about ASML. I own one share, right? One share, but as a token of respect for this company. I wanted to buy more if it would hit 400. It didn't. Okay, maybe I should have. But on top of that, they announced a 5.5% dividend increase over the fiscal year 2022 from €5.50 to €5.80. But there's a catch here. The first dividend in this quarter will be 1.37, in line with the last two quarters. But the final dividend will be 1.69, and that's where the hike comes in. My question is now to ASML. In quarter three, will this 169 be the new quarterly dividend going forward? If that's the case, we're talking probably about a 20-25% dividend hike. That's not clear to me based on the press release and such. So that's up in the air. But I mean, also the share buyback, by the way, it was amazing this quarter. And I think what was nice about it, there was a significant price dip. So they did this really well. So ASML, it's for me like it has all the tailwinds, even in this chip industry. It is doing superb.
Yeah, and I want to go back and listen to, I think maybe 6 months ago, because I'm nearly sure you predicted this. I know they shipped 54, but you were saying they were building up this inventory of 14, and they're going to ship it next year. And I think that was. It wasn't the last earnings. I think it was the one before that. So I think you predicted this would happen. But look, solid numbers all around. They've grown exponentially, as you said. There's a lot of good systems there. I'm looking at metrology and inspection. That's kind of an area I'm getting into in my work at the moment. And grew 28%. I mean, it's a European darling. It's one I don't own. I wish I bought it when the kind of capitalist mentioned them way back. Maybe it was early 2021. But yeah, I wish I owned this company.
I'm just checking the share price, what it did this week, and it is a few percent up. Because with these earnings, I almost don't even check the share prices of some of these stocks. But it's at 680 USD at the moment. So I probably should look actually at the euro one, because that's the one we follow. So 619 euro at the moment. Okay, so yeah, it had a bump up yesterday of 3-4% on the news. I think it deserves much more. And honestly, around 600 euro, it's probably with these growth numbers and predicting it in the future, it's fairly valued, in my opinion. It's just like the dividend is 1%. That makes it less attractive, but such At least I felt I had to own one share of this one, and who knows, maybe a second one in the future.
Yeah. Okay, let's move on to 3M, ticker symbol MMM. It's a company I don't own anymore, but I'm keen to watch them, and I'm sure they're quite attractive to people given the high dividend yield that they have and their history of paying out dividends. So let's look at the headlines. Their sales was down 3% year on year. Organic sales was also down. Operating cash flow was down 25%, while free cash flow was also down 25%. They say this was due to a result of capitalization from R&D for US tax purposes, and they returned 4.8 billion to shareholders in dividends and share repurchases. So this year they didn't cover their dividends and share repurchases. But then if you look at the full year outlook, they are predicting that they will have roughly 5.8 to 6.3 billion next year. So they're confident that they can cover their cash, their dividends and share repurchases. Look, it wasn't a great earnings for them, but it's kind of expected. We can see everything is starting to slow down. There's a general slowdown everywhere. So I'm not surprised that we're starting to see that. Inventory is building up quite highly. Demand is weakening. There's this legal matter then that's just, it's there. They mention it sporadically, but not enough for my liking.
Yeah.
It's still unclear the impact that that's going to have, and that's my main concern. I can live with the rest. I can understand that the outlook next year is going to be flat to negative. I mean, it doesn't take a genius to work out that that's going to happen. With the cash flow that they generate and the dividend is usually safe, I would normally see this as a buying opportunity for a company like 3M, but I just can't. Like the only thing that they have mentioned here is making progress on legal matters. That doesn't mean a whole lot to me until I start to see real numbers and what's actually happening here.
In my opinion, as CEO, then you're not reading the room.
Yeah.
And also I was a bit disappointed in the analysts here. Look, like you said, I still own it, by the way, but I have a buyer feeling here. I just hope that they get the settlement behind them. If we know what, we just need to know what the situation is, how much will it cost, and then we can leave this behind us and move forward, right? Generally speaking, the balance sheet actually looks quite okay. Yeah, so they can also turn off the buybacks at any moment. That should also not be an issue. If they, let's assume that, for instance, the whole settlements will cost 10 billion. They can afford it. Yeah, they can afford 10 billion. But if it is 25 billion, it becomes another story. Yeah. So that's just what we need to know, and because the dividend is safe. There's no issue with the dividend, because they should just, from one side, if they're really confident about their legal strength, I like it that they are repurchasing shares, that they didn't stop it. However, I don't trust CEOs that are, let's say, who are not the founders of a company or something like that, because what they have are options to get rewarded. So they don't have necessarily the long-term incentive that we might have as a shareholder. So I'm on hold with 3M. I decided not to sell them. I had to really hold myself to not buy more on the dip. But I am proud of myself that I didn't, that I kept my head clear.
I mean, if you take out the litigation, that aside, this would have the perfect recipe.
Buy. Yeah.
I mean, but like it has.
Even if I knew it would be 10 billion, I would be hitting the buy button on my mouse, and my mouse would be broken.
Exactly. Look, you have a weak outlook. They're coming off COVID where they had heavy demand. So we know they're coming from a high baseline. They're divesting in Russia. There's macroeconomics going, there's everything going against them. It would be the ideal time to buy these guys. It's just this litigation. It's killing me, because I would love to own them a little bit. But I just, as you said, we've seen it with Bayern before, and I'm not prepared to get involved until there's some clarity. And that's my biggest disappointment in this. I wanted them to address it a little bit more and give me,
like Johnson & Johnson. They were really aggressive, took it by the throat, and they dealt with it. And 3M got a major blowback on that, because they tried it and they got rejected by the judge. So
yeah, they need better lawyers. That's what they need.
Yeah, they need the Johnson & Johnson lawyers.
Exactly. Okay, let's move on to maybe Louis Vuitton, another European powerhouse.
Fucking hell. Remember Louis Vuitton that they make some, what is it, bags and such, like some leather bags. It's, I don't know even where to start. So, guys, 2021, they made 64 billion in sales. 2022, 79 billion in some spirits, wines, what else? Some fashion and leather goods, perfumes, watches, jewelry. 79 billion of this stuff. I mean, we're talking about leather belts here and such. And I mean, 79 billion. That's an organic growth of 17%. And what is also nice, they are diversified. They have sales like 27% in the US. What is it? 16% in Europe, excluding France, 30% in Asia. Worldwide diversified. All regions were growing except Asia because of the lockdowns. Yeah. But Europe, I think, was the biggest growth driver, 35%. Now, and if you look at the business units, they sell wines and spirits and everything. But by far, the largest business unit is fashion and leather goods. It makes up approximately 40 to 50% of their sales. It was the largest growing segment with 20%. I mean, how many people can afford a Louis Vuitton bag?
I mean,
if I see them in the shop, I think, like, who pays this for it?
and think about what you just said there. Okay, you said China was flat. China was flat because of COVID. I mean, so this is not even taking China into consideration. When China opens up, this could just explode even more.
Yeah, definitely. So, I mean, I'm blown away by these numbers, really, and it's really impressive for me. If we look at, let's say, the profit, they have about 21 billion in profit at the moment. I believe it's is it operating profit? Yeah, and they have actually decline in operating free cash flow compared to last year. Now, why is this decline in free cash flow? They had to pay almost 1.5 billion more in taxes this year, but also changes in working capital. So they have like a 3 billion negative working capital. That is typically inflation, inventory, these kinds of things, right? And that's why their free cash flow is effectively down. But we also need to look at the investment part of it. They also invested like 2.3 billion more than normal, so they still have a 10 billion free cash flow. But I think this is like normal. This has more to do with accounting, and these free cash flows you need to look over the years. Yeah, so now it's the working capital looks worse. Usually the next year it kind of compensates again for that. But last but not least, they had a 10 euro total dividend in 2021, and they hiked their dividend, guys, with 20% to 12 euro. It's one of those, I think, dividend aristocrats in Europe. They spent the total dividend in 2020 was 6 euro. Yeah, so now it's 2 years later, it's 12 euros. So they had 100%. They doubled the dividend in 2 calendar years. It's amazing. The 5 euro was already paid in December. The 7 euro will be paid next. I'm deeply impressed with this company.
It's probably a company I'll never own, genuinely, but they obviously have some moat, brand power, the whole lot. Because how can they keep? I'm just looking at the share price now. It hardly dipped even during COVID. There was obviously a dip, but not as much as you've seen with other companies and sectors. They seem to have such brand power. I'm just blown away by these numbers, and all for fashion, belts, bags, whiskey, and champagne.
Maybe these shares are owned by old widows of noblemen in France that don't even know how to access their brokerage account.
I don't know who owns them, but oh boy, I wish I bought into these guys in 2015 or something like that, because they've just exploded since then.
Yeah. Hey, listen up. You get them in a 1.5% dividend yield. Not too bad if you compare it with what's the ASML and Microsoft.
Yeah, it's not too bad. And look, as you said,
Doubling the dividend in 2 years.
they've doubled that dividend in 2 years. So you're not actually, if you bought them 2 years ago, if you bought them in 2020, you're getting them for €300. They're now
Yeah.
800, and then on top of that, doubling dividends. That's unheard of. Yeah.
Yeah, you would have, what is it? At least a 3%, 3.5% yield now.
Yeah, we could retire early.
yeah, exactly. But hey, if you believe that the company can do the same going forward, then at a PE ratio of 30 and a sales growth of around 20%, and we're not even talking about net income, then it is not so expensive when you look at that from a PEC ratio point of view.
But that would be my problem, because, and maybe I don't understand their business model well enough. I could not see them continuing this growth, but then their past growth shows that they can do it. So psychologically, for me, I would not be able to invest in these guys for that reason, because I think, yes, brands and so on, that it'll have to slow down at some point. But maybe on my behalf, that's a misunderstanding of their business, because their past performance is pretty sensational.